This conference will now be recorded.
Good evening, ladies and gentlemen. This is Cluelessly Trading Frank. It's approximately 8:31 p.m. Pretty much on time today, so that's good news. 8:31 p.m. on November 1st, 2020. 48 hours to one of the greatest and most critical elections coming up on Tuesday, November 3rd. So unless you voted, don't forget to vote and exercise your rights. And let's move on. Full disclosure, this is purely for financial education, not for any solicitation or advice. This is our standard weekend Sunday webinar where we go through a few things and try to predict as much to our ability, to my ability to figure out, what's going on and what might happen going forward. On that note, welcome. These sessions are recorded and directly uploaded within 20-25 minutes after we end on the real-time Twitter feed. So click that link for GoToMeeting and listen to it at your own time. And then it gets uploaded to the YouTube channel, hopefully tonight, if not by tomorrow morning. So that's just so you all know. Okay. So first of all, I don't need to remind anyone that we are going through probably one of the most volatile periods in the market since September. We're going to go through a few charts. We're going to start off with the longer term charts because that's going to give us a perspective on what's going on, where we might fall to. There's a lot of uncertainty in front of us. I don't need to remind anyone, and there could be there are great opportunities in between, and at the same time it might not be as bad as we all think. Let's just put it that way. So again, it was exhausting week, had a couple of fast movers, but hey boy, that market was it was just too fast, too quick. I know we had a couple of spy puts. I wish I had a lot more, but it's very difficult just for all of you to understand. And of course, you guys place your own decision on what you need to do. My charts and stuff are just tools for you to use, and then you look at it and you use your own discretion to do what you need to do. Is what's difficult is, and we're going to look through some metrics tonight, is when things get this critically deeply oversold on a technical level, it gets very difficult to put out a swing short, let's say, and just say, okay, that's definitively going to make money. Because people who did that, for example, other market players, and I'm sure some people within our Clueless trading community, let's say at the bottom of the market on Friday, I believe we were down at one point, lose track, almost 500 points, 486 points, and we ended not up, but from the bottom up, we ended down 156 points on the Dow, looking at the broader indices. So the key is that what's been working, what the part that's working for me is when I'm doing these SPY puts, for example, the ones that I told people to buy middle of last week or so, which were the November 2, 330, 320 calls. November 2nd, 320 calls. November 2nd meaning tomorrow. I didn't want to go out too long on those puts. Those things intraday worked out quite well. We're never going to catch, I mean, I'm sure some people can, but I don't catch exact top or exact bottom. But net, you get the meat in the middle, and that's that's a-okay. I also did put out there very clearly that given the extreme oversold readings on the New York Stock Exchange oscillator, the NYMO, which we're going to look at again tonight, which was at minus 81, 82 on Wednesday, that we would get a quick, fast rally within 24 to 48 hours, which we did, and that would be sold. And that's exactly what happened. If just to backtrack, and that's on my real-time feed. And of course, I didn't get a chance to do the Wednesday webinar. But I did mention that clearly on my real-time feed. If you scroll down, you'll see. And so that worked out quite well. And I know some great members and traders like Paul here managed to benefit from that type of very prescient and predictive call. Okay. On that note, let's dive in directly. And before I go any further, let's put it this way. At this point, the markets are so super choppy, so super extreme absolutely volatile that making a short-term prediction, whether you're using the Fibonacci retracements, whether you're using many other things that I use, tools that I use, which have worked very well over the years, is almost meaningless, because things, I notice the movement, the algorithmic high frequency trading black box movements on individual stocks, for example, during the day. And it's mind-boggling. I mean, it is just within seconds, up 15, down 30, up 10. So unless you're an active trader, best not to trade, to be honest with you. Part of trading is not to trade certain days. I know it's hard for me to do because I'm a trading junkie, and I'd like to attack the market at all given times. But a couple of things that have helped me on keeping the losses on certain days to a more normalized level, so your brain doesn't get fully shot for the next day's work, is smaller positions and taking profits faster, no question about it. And if I'm doing some active trading on the day trading side, I'm certainly taking profits very quickly. I am also getting out of positions with a 30-40% loss if needed to be. So biggest thing that has really helped me is reduced position size. So instead of having 10 contracts, I'll have 1 or 2. And if they go, they go. On the cheap calls, yeah, I have a bunch of them. If I have 40 or 50, for example, on the real cheap ones, then just giving you a hypothetical example, then I'll reduce it down to a lower number. So this way, what it does as tactical traders, it reduces the P&L volatility, which can be extremely detrimental to somebody's mental confidence for no fault of their own, because the markets are so extremely volatile, literally minute by minute. Okay, so when you see that P&L going up and down a couple of hundred points, couple of thousand, couple of $100, couple of $1,000, depending on the size of your trading portfolio, it's it's difficult. Let's face facts. Emotions are no emotions. Now, if you don't want to look at that and you just say, okay, this is where I think the markets will after the short-term volatility passes, which I believe the markets will stabilize and attempt to move higher as the volatility stabilizes, then that's a different story. All right, so just passing on a few simple things which work. So on that note, let's dive into the charts. I'm going to start off with the daily on the candlestick investing.com platform. And this is what we're looking at here.
Quick question.
Yes, of course, Chris.
That when SPY hit that level, it was what was it, 322, 323.
Okay, let me pull up the SPY chart for you. It's right here, so we can follow what you're saying. 1 second, sir. So if I'm looking at the SPYs here, let me zoom in a little bit on the shorter term side. Actually, that doesn't really give us a real good look. But let's stick to the daily chart here. Yeah, go ahead. So
yeah, it's fine. When that on Friday, when that hit that level, I mean, what is so special about the 323 level? It just rocketed up in the last 15 minutes of trading.
15 minutes to half an hour of trading.
Yeah, actually, it was like the last five minutes. It seemed like it just painted these massive green candles right up to like 327.
Yes. Correct, and those are automated programs which are designed to buy pretty much at this level. I mean, if somebody wanted to be very if somebody wanted to go like literally point by point, it doesn't always hit that exact number. Then we should have been looking at around 319.76 right there. You see that? See this line here? Because that was the bottom that the market printed on the SPYs, SPY, on the 24th of September, as you can see the date below, right there. Okay, right there. And it also did the same thing on the 21st of September. It almost went there on the 23rd, the 24th. So that's a major support level, and that's this line that I've shown on my charts. Excuse me. And that's the simplest reason why the short covering programs went into effect. And it wasn't necessarily new buyers, just so you know, Chris. It was basically just the automated short programs that are run by the hedge funds and the institutional funds players. basically the quant funds, as we call it. So they automatically went into overdrive, just covering their shorts, and that's the reason why that happened. It's this candle here, what we're talking about. So if you look at it, it was still red, but if we zoom in, like you're saying correctly, it was within the last. This was Friday. And it was this what you're talking about. It actually started off at around 135, right there at 135. Sorry, 335. My apologies. It initially started off at 245, then came down and retested almost the same level at 335, and then some big shortcut. These candles that you're looking at, which are primarily very large, very fast moving short covering programs, and the volume exploded right there. So it just literally exploded. You can see that. I mean, that was the highest buy vol green bars. That's purely because of short covering.
Hey, Frank?
Yeah, go ahead.
Okay.
I just like to get your opinion on kind of a way of thinking I'm looking at. We all know, and you've discussed it many times.
Just
Yep.
bear with me 1 second.
Yep.
Chris, did you have a follow-up question to that? Because that was a very good point that you brought up, so other people can also see, what I just showed.
Well, yeah, I was expecting this to go down and hit, basically at least match that low, that September low in 318.
To be exact, it was 319. 1 second, sir. It was right here. 319.55. Now,
Yeah.
one of the things, Paul, I'm going to come back to you in 2 minutes. One of the things that I've seen happen, and we are, after all students of the market, right, is that when everybody's looking at that exact spot, they will start to do it a little bit earlier. Do you understand what I'm saying? So that's exactly what happened. So everybody's looking at that 319.55 level right there. And they started to do it at the short covering started at 322.56. So I've seen this happen quite often. It doesn't always get there. It starts a little bit earlier, not to the exact dot. So that's the answer to that question, and this I've seen happen a lot.
Okay, got it. Thank you, Frank.
Yeah, not a problem, sir. Paul, go ahead with your question.
Thanks, Frank. Yeah, so I was just wondering your thoughts on this idea. So we know, and we've discussed on your webinar many times, there's about $5 trillion on the sidelines that was pulled out since March, and really none of that money really came back, and if anything, probably some more on top of that came out. Does that give us a bit of a cushion? Because with Christo's question there too, with the Friday, I got the sense too that there was a lot of people taking advantage of easy short money, and they were probably covering at the end of the day. Do you get the sense though that there's like there's not real longs that are selling? It's more the short sellers, and maybe our downside is limited because all the cash is already taken out. It's a record number of cash that was taken out.
So let me answer this question. It's such a fantastic question based on the same question you had asked me about 2 weeks ago or so. And my answer, if you guys remember correctly, was that no, I don't think. Remember, it was like a month ago or 3 weeks ago, you asked me the question, do you think the $5 trillion might, some of it might be starting to come in? And my answer is, I said, no, I don't think so, because of the uncertainty that's looming in November. So I'm going to answer this question this way. This time I actually agree with you. And why do I agree with you? Well, I agree with you that part of that 5 trillion at this point is going to start to siphon back into the market, not just because we have had 9, 10, 11% corrections on overall indices on an intraday basis, or just over the past, this was one of the, since just October 12th, 3 weeks ago, but also because this time, with the elections getting over, I believe there is going to be a level of certainty where, regardless of whoever wins, they are going to say, you know what, at least we know what we're dealing with. And I think this time round, part of that 5 trillion in certain sectors, and I'm sure it's going to be also, a lot of that trillions that came out of the what do you call, the tech sector, and the solid companies, which are growing at 30, 40, 50% a year, despite all the COVID-19 and the global uncertainty and all that stuff. I believe a lot of that is going to go straight into that, and of course go into some value companies, go into some retail companies, go into the airlines, and things like that, because after all, they will have some level of certainty, and hopefully the COVID-19 situation starts to, dampen down a bit, and the airlines have all started their antigen and COVID-19 immediate tests right there at the terminals. So hey, you get in there, you're fine. Like I said, it'll happen. So yes, in answer to your question, Paul, I do think that that money at this point, some of that money will start to filter in if we don't start to see a spiraling down of any political ramifications after the election, which is still a little bit of an unknown. And if some larger, and remember, we have a whole bunch of earnings to still come out over the next couple of weeks. So if some of them don't go are not that extremely downbeat on the forward guidance, yes, I do believe that money can will start to come in, and that's going to be a huge boost to the markets. And if you look at it from a technical standpoint, basically we are at this point, and it obviously takes a couple of days for us to see that. Let me just change the color right there. We have a definitive double top here, right there. We were analyzing this. It was looking like a nice consolidation channel till it broke below the 50. Now we are considerably lower below the 50-day moving average. I would say the standard deviation right now is probably about -3 or so. And it's exactly the same that had happened back in September. So if you want to look at this pattern symmetry here, at this point we had a nice inverse head and shoulder, which hit almost, again, not exactly, but almost towards the all-time high. It was almost getting there. And now that we broke down, this pattern here, the zigzag down in two tranches, is exactly the same as what is happening now. Now, one of the other interesting things that happened tonight is when you looked at, I know we had a time change, when you looked at the Globex futures when they opened at 6 p.m., we were down about 20 or 30 handles on the S&P 500. The S&P 500 has now turned around and up 7 handles, which is fantastic. That's almost a 27 to 30 points higher from the lows just within the past 2.5 hours, 3 hours. We have the NASDAQ up about 24.5 points, the NASDAQ futures and Qs, and we have the Dow Jones Industrial Average up about 46 points. So saying all that, if I'm just focusing on a very simplistic basis, and these things, keeping it simple at this stage is actually the best policy, in my opinion. That's what's worked for me over the years, is this is the pattern we're looking at. Now, here is that major line that if the market does cross, there is going to be another fast selling, and it probably is going to be an intraday move where if we do break below that 320 level or 319.77, let's call it 320, we're going to see a fast move down to retest this rising 150-day moving average, which most of the media doesn't cover or anything, but this is looked on and played upon by hedge funds, and believe it or not, it's still rising, believe it or not. And the first thing you're going to hear is a retest of the 200-day moving average. This is still a possibility. So let's keep that in mind here, okay, because of the uncertainty going ahead with elections. Hopefully it'll be a smooth transition and everything's going to be fine. But the 200-day moving average down here is 312 on the SPYs. So you're looking at about 3,100, 3,120 on the S&P 500. And that is still a possibility. Okay, let me go back to the SPX because that's is a more not reliable. SPY is too, but if we look at this, it's very clear cut and dry. We have a definitive neckline right here. Here's your double top. Okay, here's your neckline. So and these are head and shoulders too. It's a double head and shoulder. So basically, this neckline is 3194. The very simple numbers, and these are the numbers that the machines are following. If this 3194 is not held, then obviously we are going to see a sharp move down, and that's going to attack the 3166 level, which is the rising 50-day moving average. I'm sorry, 150-day moving average, and then we are going to. And then the 200-day moving average comes into play at around, what is that, 31. Let's call it 3130. So these lines are, believe it or not, still in play. And but again, all depends what's going to happen over the next 48 to 72 hours, to be honest with you, and possibly, you know, a couple of days more. Now, looking at the short-term pick, I mean, looking at the internals to see, this is just like here that happened back on September 1st, and this started on October 12th. Very, very fast multi-day pullbacks. Some attempts to recover, but then getting slammed. We are there. I mean, we are definitively in extreme oversold levels, no question about it. However, keep in mind that just the way when markets are rising, they can stay overbought, over 80, or on the STOs, on the RSI, for example, can stay over 80, shows the strength of the market as it keeps on climbing. The same thing can occur on the downside. They can stay below the 20 mark for a couple of days. They don't necessarily need to come down and immediately turn around. So the key is that we have to keep that in mind. And that this had happened back here where we stayed below the 20 STO, in this case, the full stochastics, which is the first derivative of the relative strength index. We stayed below that as the market slid, had big rallies, slid, big rally, slid, but then it started to bottom, and this took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 3 trading weeks, almost 3 trading weeks. And guess what happened? It stayed below 20. Now, will that happen this time? I don't know. We shall see. There's a bunch of metrics that I look at, bunch of indicators that I look at. The dailies are looking quite oversold. So a short-term bounce is very, very possible, but the weekly, and we'll see that on the McClellan oscillator, on the weekly, it's still showing down, which means still a little bit more selling to come before we have a real definitive bottom. Now here, if we look at it, this is bottoming. McClellan oscillator is kind of like, hanging in there, and the MACD is still pointing lower. It's following the same trajectory as the full stochastics. So that's what I'm getting at. That the downside targets are still there. And I wouldn't be surprised if things get a bit too messy over the next week or so, that we come down, and very quickly, I'm talking within 24 to 48 hours, test the 200-day moving average, which will definitively, in my opinion, like it did back in June and in the month of June, twice in the month of June, create a sizable tradable bottom, which will trigger a multi-day, multi-week rally. Just want to be clear on that. Okay, I'm being very neutral at this juncture here because of the technical damage that has happened in the market. So looking at the 3-week chart here, I'm sorry, not 3 weeks. This is the weekly chart. This is what the weekly chart looks like. And one must, at this point, one must look at these things. There's no question about it. What happens in one single day, whether it's a short covering rally at the end of the day and such, honestly means nothing for the next day. And we have seen that happen repeatedly in the past week to 2 weeks. I think all of you would agree with that. This candle is one big one. There's no question about it. So if you want to look at it from a bearish standpoint or a cautious standpoint, you would say, man, this could expand like this. In that case, those lines that I talked about, the 3100 level, the 3200 is just something we retest, like, we can retest tomorrow, for whatever reason. So that's not the real levels. The real level is the 50-week moving average, which is 3136. The 3100 level, basically the 3100 level. So which means that we would fall another 170 points, 170 times, just to give you guys an idea, times taking the higher factorial, that's another 1360 Dow points. Is that possible? It certainly is. That's the reason. One of the things that I plan to do is not necessarily, and this the people can just do whatever they need to do, is not necessarily have large amounts of money put out thinking that, okay, next week is going to be a better week. So I'm going to keep my trades very close to the vest. I'll be a little bit more active in the daytime, taking scalp profits and such. After all, we all going to make money, and that's going to be my strategy, at least for the short term going forward, because these ones, if you look at it, it is it's again, I'm not a fear monger. You know, I'm overall bullish on the markets. I'm just saying the short-term picture is something that we have to be very cognizant about. Now, if you look at it here, if we look at it here, let's look at the stochastics. If you look at the stochastics, it doesn't look good. I'm not saying it has to go all the way down to the March levels, which is a kind of a generational buying opportunity, and you can get real rich real fast by buying these type of bottoms. But we would need on the daily, on the weekly, this baby to start turning, obviously. And the only way that it's going to do that, because this is a weekly chart, technical chart, the only way it's going to do that if we have multiple days of positive gains on the daily. That's going to turn the weekly charts on the other direction. I just want to be clear on that. So this certainly does not look good on the weekly. Okay, it's a definitive crossover down, and one has to be again cognizant and alert about this matter. The McClellan oscillator is really moving sideways. It's not doing anything, but this one is also something that one has to keep an eye on. We do have the first crossover that started on the 26th of October on the MACD. Now these are very simple indicators, but they're very effective if you track them. So, and we have the first red histogram that went in, and that was last week. Obviously, look at the size of this candle. It went red. Now, will it expand down, or will it simply kind of be shallow and then turn green again? Well, obviously, I'd like it to be shallow and turn green again in order to hold some longer positions and you know, want the and hope the markets go higher. But this is definitively on a weekly basis something one has to watch out for. On the daily, I've already gone through it, so I don't want to hammer it down too much. As we can clearly see, let me get this out, erase all drawings. We are in that short-term deep oversold zone in the -25 on the MACD. It's the same thing that happened before we turned hard on the 24th of September. So this is actually pretty good. It might slip and slide a little bit more, or maybe it just turns from here. McClellan oscillator is fine. And of course, I explained that this is a deep oversold level, and we could see a turn like this. And even a turn like this is a couple of 100 points. Things are moving so fast. And if you notice, we can open down 600, 700, 800 points, or during the day, go down 800 points and then be up, and then not necessarily up, but be only down 150 points by the end of the day. That itself, on an intraday basis, is great money-making opportunity. Whether you play the indices, whether you play the Qs or the SPYs, primarily those are the ones we're looking at, or even the IWM or the DIA. So intraday, when you get that type of fluctuation, I would suggest to tactical traders to take advantage of that, because those things normally would take a couple of days. Now it's happening within a couple of hours, almost every day. So saying all that, the broader picture in the global economy is pretty okay. Yeah, England is shutting down a bit, but they're not going through the severe lockdown restrictions that they did back in March. They have selective shutdown. You know, they're talking about certain parts of the U.S. You know, they'll have selective lockdown. It's not going to be the dramatic, like that's it, everything's shut down kind of thing. And the markets, like they say, they took the first blow in March, so now they can kind of deal with it. They can deal with it. Let's take a look at the same daily chart on the E-minis. And you can see here, this is actually quite constructive. It's the same daily chart, but this is the more dynamic 24/7 Globex E-mini futures. And you can see here that this is where we are. Now, here's the best part of the news, just purely from a technical standpoint. When you move this far so quick away from the 50-day moving average, like I always try to use the simple analogy, when you veer that much away from the standard highway, because these are the highways that the markets would normally follow, then you always have a mean reversion play. In other words, you revert back to the mean. What is the mean in this case? Is the 50-day moving average. So every single time we have broken sharply below, and the most recent being in September, only a month and a half ago, or something like that. Yeah, You always, one way or the other, get back towards the 50-day moving average. Now, whether are we going to break above that, that's a different story. But that mean reversion play itself is extremely profitable for traders. So that's what I'm getting at. Can we slip and slide a little bit and hit that 31.96? We got down to 32.24, and as Chris pointed out, we never got to that 31.99 or 3200 level. Well, it happens. You know, it doesn't always have to get there. Maybe we get there. I'm not sure. But what I'm getting at is that we are starting to see a definitive pattern here coming into play that is going to be quite profitable for traders. Defined head and shoulder, inverse head and shoulder, sorry. This was looking like a cup. It was holding, it was trying to break out. I even drew a chart saying projected that maybe this would happen, but nope, it went bang, bang, bang. All right. So basically at this point, if you want to look at it this way, we are starting to form a nice W formation. Now, will the W formation blast through over the 50-day moving average? I have no idea. But I'll be watching it, and I'll be not just watching it, I'll be trading it. So at this point, we are starting to see a nice W dragon bullish formation if we can break above these parameters that are drawn here. And the first level of direct contact where there's going to be a